Hi there, welcome to Kneppy Invest. It is December the 1st, which means it is time to give a monthly update to the performance of 3 portfolios that I am tracking. If you are new to this video series or new to this channel, I'll just give you a brief introduction to the 3 portfolios that I am tracking. Before the start of the financial year, I asked viewers of this channel to give me 3 companies they think will significantly outperform the market over the next 5 years. Then I collated the results and came up with a hypothetical portfolio of about 25 to 30 companies. And the reason I wanted to set up this portfolio were twofold. The first reason was all about passive investing. So you choose 25 companies at a certain point in time, and then you don't buy or sell those companies within that portfolio. And I just wanted to see what a completely passive investment strategy, how that does perform over the long term. Because I have heard that a completely passive investing system can work, but I am skeptical about that. The second reason I wanted to set up this group portfolio has to do with centralized versus decentralized systems. For instance, if you take a fund and fund managers right now, they will set up a portfolio, but it's only going to be a few people choosing the companies within that portfolio. So that is a centralized system. And all those who are buying into that fund have really no say about what companies are chosen in that fund. But just imagine if we go to a more decentralized system where the members of the fund itself are choosing the companies that are put into the fund. And I just wanted to see if that could work over the long term. And I am actually a believer that if the members of a fund can choose the companies that are in that fund, that the performance of that fund will significantly outperform the market over the long term. And I believe that's where we're heading in the future. The other 2 portfolios I'll be tracking or am tracking are 2 personal portfolios. The first one is a short-term sentiment. Now, I tested this short-term sentiment strategy in financial year 2020, and it did significantly outperform the market. And I just wanted to see if I can continue doing that. Unfortunately, I was neglecting that portfolio and that strategy during the first 4 months of this financial year. And I've become a little bit more active in the past month. And the second personal portfolio is the long-term buy and hold strategy that I've been using ever since I started investing. And that has been performing quite well, has always performed quite well for me. And I just wanted to compare the returns of that to my short-term sentiment portfolio and also the group portfolio. Now, in my opinion, the group portfolio, because it is the centralized picking system, a group of people have chosen the companies in that group portfolio, that should outperform my own personal portfolios because that's a more centralized portfolio, only chosen by one person. And at this point in time, without really giving away any results so far, the group portfolio is outperforming my 2 personal portfolios and significantly outperforming the market. So let's get stuck into it. But before we look at the performance of these 3 portfolios, first we're going to have a look at the state of the markets. Since I am doing an update for these performance of these portfolios on a monthly basis, I thought I'd just look at the XGO monthly, and this goes back about 17 years to 2003 or 2004. And at the moment, we are or have been trading in this upward sloping channel since the end of the GFC, and we have been near the top of the channel over the past few months. We did see the XJO go up 11 months in a row up until September this year, and we have seen the XJO for the last 3 months, September, October, November. September it was down a fair bit by over 2%. In October it was down slightly, and then in November it was down another 0.92%. So we have seen the XGO and the Australian markets go down 3 months in a row. The last time we have seen Australian markets go down 3 months in a row was way back towards the end of 2018. Yes, even during the COVID-19 financial panic, we did not see the market go down 3 months in a row. It went down by a large amount 2 months in a row, but we saw actually the market go up in April of 2020. And back towards the end of 2018, the last time we did see the market go down 3 months in a row, in fact, it was down 4 months in a row, was around that time when the Fed in America was suggesting they were going to raise interest rates. And as soon as they started suggesting that, that's when we saw the markets tank, because that is the worst thing that could happen to a lot of companies in the world, particularly unprofitable companies. And that's why the tech sector got hit massively during that period. But right now, we are still near the top of the channel. So even though we've seen 3 months of, downward pressure to the XGO, I still think over the medium term, we'll still see the markets go up. So I'm neither really bullish nor bearish right now, unless we start to see weird things happening with this new variant, this Omicron variant, and maybe its resistance to the vaccines and that sort of thing. That would cause some chaos in the markets if that sort of thing happened. Someone did suggest to me that I should be just looking at the log instead of linear charts, and this is actually the XGO log chart back to 2003. And to be honest with you, there's not much difference between the linear and log chart for the XGO over this period of time. I do look at log charts over really long periods of time. For instance, if I'm looking at the Dow Jones, S&P 500, I will look at log charts over a multi-decade period. But over shorter time frames, I'll definitely just focus on linear charts. And one of the reasons I do focus on linear charts is you can see an exponential rise in the linear charts over a short period of time, which is smoothed out when you look at the log charts. And one of the things you will find just before we do see a bit of a correction in the markets is in the linear charts an exponential rise, and you won't see that in the log chart. So that's one of the reasons I will focus on linear charts in the shorter terms, but when I look at the real long terms, I will focus and look at log charts. Before we have a look at the performance of the group portfolio for November, I just want to go back to October just to see how the portfolio is doing during the first 4 months. And the overall portfolio was up $13,500 during the first 4 months. And all the heavy lifting for the group portfolio were by 2 companies, Novonix and Lake Resources. Together, combined, they were up $16,500, which means if you took those 2 companies out of the portfolio, the overall performance would have been down for the first 4 months. But this is the whole reason, the whole point of having a diversified portfolio. You're going to have more likely that a few companies in your portfolio would do the heavy lifting over a certain period of time. And some might argue that if you had a more concentrated portfolio that focused on Novonix and Lake Resources, the returns in the group portfolio would have been significantly higher. But then you have a higher chance that you might pick some duds in a concentrated portfolio, and then your overall returns would be significantly lower than they are in a more diversified portfolio. So the whole point of picking 25 to 30 companies is the knowledge that there is a possibility a few companies in the portfolio will significantly have higher returns than the rest of the companies in that portfolio. And that's exactly what was happening in the group portfolio to the end of October. And this point is even amplified as we turn our attention to the group portfolio's performance to the end of November. Novonix had an absolutely stellar November. Share price rose something like $4 to $5. And by the end of November, November 30th, the overall returns for Novonix was up to $17,500. Lake Resources share price actually went down over the month, but still returns for Lake Resources at $6,500. Combined, the returns of Novonix and Lake Resources at about $24,000 compared to the overall group portfolio, which is up only $20,500. So if you took out Novonix and Lake Resources again from the group portfolio, the overall returns would be down. So again, it just shows you the importance of having a diversified portfolio. If 1 or 2 companies in the portfolio can significantly outperform the market, your performance of the portfolio will outperform the market. The other thing you'll notice here is a difference between the best performing companies and the worst performing companies. And this is why going long is a great thing as an investor, because Novonix is up $17,500, Lake Resources $6,500. Even the next two best performing companies, Unity Group up just shy of $1,500, and BrainChip up $1,000. You compare that to the worst performing companies, Kogan down $1,500 and Tesseract down $1,100. And if you come to think about it, the worst you can do when you go long is down 100% if a company goes bankrupt, something like that. But the best you can do is infinite, 1,000%, 10,000%. And you can see this just with the group portfolio. Novonix is up something like 400 to 500%. Lake Resources is up a couple of 100%. And the worst performing companies are only down about 40%. And this is why investing is a great, or can be a great compounder to you if you remain focused on those companies that are giving you the best returns. And why being patient and maintaining your holdings in those companies that are going through the roof, like Novonix and Lake Resources, can amplify your returns over the long term. And maybe why a passive investing strategy can be a good strategy to have. Hopefully I wasn't rambling on and was making a little bit of sense during the end of the previous slide. But as we turn our attention to the performance of the group portfolio compared to the STW, which tracks the ASX 200, and we want to compare the performance of the portfolios to an ETF that tracks one of the ASX 200, ASX 300 funds, is because we get told a lot that it's too hard to beat the market and we should just put our money into an ETF. So we want to see if the performance of the portfolios, if the performance of our strategies can outperform the market. And it's pretty obvious when we compare the performance of the group portfolio at 20.5% compared to the STW, which is up 1.7%. In fact, the STW is only up because of dividends. The capital gains in the STW is actually down 0.4%. So at this point in time, after 5 months, this group portfolio is significantly outperforming the market. Onto the performance of the first of my portfolios, which follows a short-term sentiment strategy, which I sort of went against during the month in terms of the companies I purchased. Over the first 4 months of the financial year, I was a little bit neglecting this portfolio, which means the returns that I did see were down from the overall market. So I decided I had to be a little bit more active, because the whole point of this portfolio is to be a little bit more active. So I decided to sell out of 9 companies because the share price was going down, or there was some negative sentiment behind the company's share price. And those 9 companies were Select Harvest, 5GN, IOOF, Brickworks, BetMakers, Aries Resources, Atomos, Bravura, and Tesseract. I've transferred some of those companies to my long-term buy and hold portfolio because I do think they have long-term potential. And the 3 companies I bought, Whisper, AI Media, and Babcorp, I bought not because the share price was had moved into an uptrend or because there was some positive sentiment behind it. I bought those 3 companies for different reasons, but not for long-term reasons, or just for short-term reasons. For instance, I bought Whisper because it was at a long-term support level at around $2.10. And a few days after I bought them, they released an upgrade, but it looks like that long-term support has been broken. So I might be selling out of Whisper soon. AI Media share price fell about 30 or 40% because a broker put out a negative report, and the market, I think, overreacted to that report. And Babcorp I bought because the CEO resigned, not straight away, but he's retired, or he's going to retire in about 6 months. The share price fell 20 to 25%. Again, I thought the market completely overreacted. And both those companies, we have seen the share price starting to recover. But overall, I have almost $50,000 of cash in this portfolio. And in fact, Net Wealth, who does run my super fund, sent me a message saying, I have a lot of cash available in my super fund. Am I sure I want that amount of cash? And at this point in time, yes, I do want that amount of cash because I am neutral in regards to the markets. And if we do see a significant correction, I want some cash to be able to deploy to buy some companies for the long or even short term. So yes, I do want a little bit of cash on hand right now because I am neutral in regards to the markets. The best performing companies in this short-term sentiment are Johns Lyng Group, and this company is completely overvalued, but the market's not seen that, and the share price just keeps on rising because of positive sentiment. OFX Group, same thing. Share price keeps on rising. I don't think that's overvalued. South 32 have held for about 15 months, and again, share price keeps on rising. CSL, I have that in my long-term buy and hold portfolio, also in my short-term sentiment. And again, the share price of CSL is in an uptrend right now. TPG Telecom, Treasury Wine, and then AI Media, which has actually risen in share price since I bought into them. The worst performing company in this portfolio is Stonehorse Energy. Now, I only have, or the value of that holding is only $1,100, and I've already profited from that company because when the share price rose to something like 4 cents, I took out not only profits, I took out a significant amount of profits. So I'm really not following that company all that much, but its share price has fallen to 1.9 cents, and I'm just not willing to sell out because the value of that holding is only $1,100. Becoming a little bit more active in this portfolio has worked. Was down at the end of October. In fact, the overall market was beating me, but now I am up, or this portfolio is up 3.2% compared to the overall market up 1.7%. The overall aim I have is to double the market returns, and I have moved because I've been becoming a little bit more active in this portfolio. The overall returns in this portfolio is almost double the overall market. So I am happy that being a little bit more active has worked wonders for this portfolio. Now to the performance of my personal long-term buy and hold portfolio. And the whole strategy behind this portfolio is to buy companies for the long term, companies I think will outperform the market over a 5, possibly even a 10-year period. A little bit less active than my short-term sentiment portfolio. But I did make one disposal in the month. That was Beam Communications, because the share price had run up way quicker than I wanted to. And I thought the company was completely overbought, and my conviction behind that company was not high enough to maintain a holding. So I decided to take profits. And sometimes we'll say that you should remain patient. Don't sell, because if you remain patient and ride your winners over the long term, you will become successful. But sometimes I think it is wise to take profits. Last month I took profits with Revism. This month I've took profits with Beam Communications. Because I made no acquisitions for the month, cash on hand at the end of November was $6,400. And overall, this portfolio has been doing well, but November was a bad month for this portfolio. It was down a significant amount. And the best performing companies right now in this portfolio are ViraSuite, AmberTech, MyDeal, and Ansarada, which I did buy in the middle of October. So that has been a really good performing company from when I bought, up 45%. The worst performing companies are Orbital, Electro-Optics, X-Tech, which are all similar companies. All three of those companies have been affected by COVID-19. And right now, I think the share price of all three companies is looking really attractive for the long term. And I am thinking of taking further positions in those companies, particularly if the share price falls even further. But I'm just going to wait until I see signs that the sentiment has shifted to more positive. So I'm very happy with the overall performance of this portfolio. And again, this shows you the benefits of diversification, because we have had a few companies in here that have underperformed, but overall, the best performing companies have outperformed in terms of percentage gains the worst performing companies. At the end of October, my long-term portfolio was up about 20%, so I was very happy. But slightly negative November, but the overall returns for the long-term portfolio 16.2% versus the overall market 1.7%. You have to be happy with those sort of returns over a 5-month period. So can't complain, even though November was slightly negative for the long-term portfolio. Now to the 5-month performance of the 3 portfolios compared to the STW. And the number in brackets here is the performance of all 4 to the end of October. For instance, the STW was up 1.98% to the end of October. Now it's up 1.72%. Let's compare the returns of the STW to the 3 portfolios. The group portfolio had an absolutely outstanding November, all thanks to Novonix. At the end of October, it was up 13.78%, now up 20.52%. So congratulations to the group portfolio. Congratulations to the group who chose the portfolios of portfolio constituents, and especially congratulations to those who chose Novonix. The short-term sentiment portfolio was down 0.17% to the end of October because I was neglecting that portfolio. Because I paid a little bit more attention to the portfolio, it is now up 3.24%. So it also had a fairly good November. However, my long-term portfolio was actually down a fair bit during November, decreasing from being up 19.84% and now only up 16.2%. The main thing I take away from the performance of the 3 portfolios compared to the STW is the reason why I don't invest in ETFs and am a stock picker. Because if we put a bit of time and effort into picking stocks, we can significantly outperform the market. So don't listen to those experts who say you can't outperform the market. You can. They just want to put all your money into ETFs. So more than likely, they are people who have derived ETFs. They are people who tell their clients to put their money into ETFs. We can and are able to beat the market. So if you are willing to put time and effort into stock picking, I do recommend doing that, even though I'm not a financial advisor. Whenever I get to the end of a month, I decide on some goals for the next month. For instance, one of my goals for November was to stop neglecting my short-term sentiment portfolio. And I fulfilled that goal, and in my opinion, that goal was successful because the performance of the short-term sentiment portfolio was quite good. My 2 main goals for this December are, in terms of my short-term sentiment portfolio, is to think about deploying some of the cash I have accumulated over the past few months, particularly during November. But I want to remain patient. I don't want to deploy all that cash straight away. So I want to look for opportunities. So those opportunities are in regards to companies releasing profit or earning upgrades. And whenever I see a company releasing a profit or earnings upgrade, that is a possible opportunity. But I want to see if the company's share price moves into an uptrend and the sentiment shifts from maybe a neutral to negative sentiment to a positive sentiment. That's when you want to take a position in a company. So wait for those opportunities. Don't deploy the cash just because it's there. Now, in regards to opportunities, the second goal I have is to search or research for long-term opportunities, because I have about $6,500 or $7,000 there just waiting to be deployed. And I don't mind to be fully invested within the long-term buy and hold portfolio. And ideally, I want to be completely invested in that. So I want to do some research, look for some long-term opportunities. I've already found some. I won't mention those possibilities right now, but I am ongoing doing my research on those long-term opportunities. That's all I have for this performance update to the group portfolio and 2 of my personal portfolios. A 5-month update. I can't believe it's already been 5 months since the start of the financial year. If you have any questions about this video, any of my portfolios, any of the companies that I've mentioned in this video, make sure you leave a comment, question, or your thoughts in the comment section of this video. Otherwise, and more importantly, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.